Welcome to Books in Five, where we interview the authors of recently published books on relevant topics. We'll be asking the author 5 questions, and they will have 5 minutes to answer each one. I'm very excited about my guest today, as he has written an excellent book about the Canadian financial industry. Andrew, thank you so much for being our guest on Books in Five. Please introduce yourself, the title of your book, and where you are joining us from today.
Well, Pavan, thank you very much for that introduction. My name is Andrew Spence. I'm the author of Fleeced, Canadians versus Their Banks, published by Sutherland House Books about this time last year.
And where are you joining us from?
Oh, sorry, yes. I'm joining you today, rather, from Toronto.
Amazing. Let's begin with our first question. You are very well placed to comment on the Canadian financial system being set up in a way that benefits the big six banks and harms consumers. Tell us more about your motivation to write this book and what you were seeing from your perch inside the belly of the beast.
Okay, well, interesting question. And so the motivation to write the book, I'm an economist by training. I started my career at His Majesty's Treasury in London quite a long time ago now. And so I've always been motivated and interested in public policy. I migrated here to Toronto about 30 plus years ago, worked in the financial sector, both in a couple of the Canadian banks and also a couple of big asset managers. And I started a small business about 5 years ago, offering economic consulting and advisory services, as well as financial consulting to pension plans and independent asset managers. And I think we all, as Canadians, know that the economy has not been serving us particularly well. So if you take a broader sweep, an examination of the Canadian economy, we find that there are oligopolies in all of the major strategic industries in Canada. That includes only 2 railroads, maybe 2-3 airlines at best, 5-6 banks maybe, who have a very high concentration and dominance of the industry, 2, maybe 3 telcos at best, and a heavy degree of concentration in the provision of retail groceries across the country. And so what do we know about oligopolies? We know that they produce at a higher price than a competitive economy would deliver. They also deliver less in quantity. And so I don't think it's a surprise to anybody, but I'll give you quite a shocking statistic, which is that since 1980, Canada's per capita income has fallen below the United States by 25%. Now, the US is a unique economy. There's no one like it in the world. So it's a difficult comparison and in some ways not terribly meaningful to compare Canada to the United States for a variety of different reasons. So the better comparator is Australia. But even there, we don't measure up particularly well. Australia has managed to generate per capita income 20% more than Canada has been able to over the last 40 plus years. A lot of this, I think, we can trace to Canada's oligopolies. They have very little incentive to compete because they don't have to. And so I decided that really to write a book examining the banks and their role as one of the many oligopolies. Why? Because they are the most important industry in the entire country. Banking is a piece of public infrastructure. It allows us to make payments. It provides financing across a broad swath of different economic activities. And what bothered me particularly was the amount of financing that goes to small and medium-sized businesses. This is a really important sector to get financing. It accounts for a little over half of Canada's GDP, and it's 2/3, or employs rather 2/3 of the employed and active workforce. And yet, the financing that small and medium-sized businesses get in Canada is much lower than it should be. For instance, the Canadian Federation of Independent Business does a survey every few years called Financing Main Street, and they found that the median amount of credit provided to small and medium-sized businesses in 2022 was a mere $156,000. This for half of GDP and two-thirds of employment. So that's the quantity piece. The price piece is that small businesses pay 2.5% more than large businesses for equivalent financing. And if we do compare it to the US, which has a more competitive banking system, they charge a mere 50 basis points over large company loans. So whichever way we cut it, we've got higher prices and lower output. Pretty much the standard feature of oligopoly.
Let's move on to our second question. And you've already brought it up, but let's dive a little bit deeper into it. The way that banks originate and control loans should contribute to the nation's overall prosperity, but that is not the case in Canada. Why is it so hard for small businesses to get financing and homeowners to get mortgages?
Well, let's deal with the mortgage piece first. There are, in a sense, two types of mortgages when you come to borrow, and banks dominate the provision of mortgage financing in Canada. This is a big change compared to 40, 50 years ago, when banks were minority providers of mortgages. Now they dominate the market. So depending on the requirements for the down payment, right? So you have to put a down payment on the mortgage because there's volatility in house prices. And so the amount of capital you put in place is there to absorb any change in the price of the value of the home so that you do not have an incentive to default on that mortgage. So you absorb the price risk. So banks want, and the regulators require, fairly hefty down payments, 20 to 25% of the price of a home, which today is very difficult for many people to access. And so banks have to provide capital against mortgages. And if they are uninsured, the amount of capital they have to apply to that uninsured mortgage is higher than it would be to an insured mortgage. When I say insured, it's mostly provided by CMHC, Canada Mortgage and Housing Corporation, which is basically standing up and saying, I'm going to effectively co-sign the equity risk on a mortgage borrower. For banks in that situation, they have to put less capital against mortgages. And so they have a reasonably good incentive to provide mortgages to the population. I don't think that's a serious issue. The biggest issue really is the price of the mortgage. Sorry, the price of housing, right? Which makes finding that equity for many people very difficult. Now, turning to small and medium-sized businesses, these are much, much, much more risky loans than a mortgage, right? Because a mortgage is essentially a collateralized loan. So if you do default on the mortgage, the bank can seize the property. It can recover its outstanding credit, and then whatever is left over the homeowner gets. And that may be a situation where the homeowner walks away with nothing. With a business, it's not clear, especially in the early stages of business formation, that there's anything there for the banks to seize if the business goes under. And so it's quite right that banks exercise a significant amount of credit oversight against potential borrowing because they have an obligation to their depositors, right, to pay them back. And so they would have to put a lot of capital, the bank's own shareholders' money, against small and medium-sized businesses, which for them means that they have to raise more capital. It's more expensive for the bank. There's less available for shareholders. And so they have an incentive to be very, very careful about how they allocate that credit. So we understand why. It's a chicken and egg game, right? Do we have lower credit because banks are doing a really good job, or right to protect their shareholders, or do we have less credit to small and medium-sized businesses because they're avoiding all risk in that sector? We're not entirely sure. But we do know from the price and the quantity that we deviate from other countries quite substantially. Now, Canadian banks get about half of their earnings from fee income, fees on credit cards, fees on payments, fees on bank accounts, fees on overdrafts, fees on you name it, right? There's a fee. And so, if you are presenting yourself to an investor and that you want to borrow money, then you want to offer that investor the lowest possible risk that you can. And that gives them an incentive to seek fee income rather than taking risky loans. And because there's very little competition in the domestic marketplace, banks will do what is in the interests of their shareholders. And this is the situation we've arrived at.
Let's move on to our third question. The most infuriating chapter in the book details how the banks use credit cards to juice their profits. Walk us through the reasons that credit cards are pushed onto customers with such extraordinary efforts by the banks.
Well, it's very simple. The answer to that question is that the interest rates that are charged on credit cards are extraordinarily high. So let's say at the moment, the highest rate will be on a cash advance. You want to borrow against your credit card. They'll charge you about 23% for that. And just think about what that means, right? If inflation was at the 2% Bank of Canada target all the time, and it isn't, but, until recently because of the COVID supply chain breakages and the surge of inflation we had, the Bank of Canada had pretty much delivered that 2% since 1991-92. So if you take that 2% away from 23, what do you get? 21% real interest rate. It's punishingly high. Now, in the book, I observed that back in 1981, the interest rate on credit card was about 25%. The prime rate, which is the rate at which banks will lend money to their best customers, was 22%. So they got a premium of about 3%, which is a pretty good risk premium. Now today, let's say on that 23%, the prime rate is 4.7%, and so the real rate is 18.3% compared to 3% 45 years ago. So as inflation fell over that period, from something like 12% to the 2%, and the bank rate, which today we call the overnight rate, fell from 21% to today 2.75%, or let's say 3%. Credit card rates did not come down. So imagine if you go into the bank and you don't have much of a credit history and you want to borrow some money for whatever purpose, and you ask for a prime loan, you're likely to be shown a credit card rate instead, because the banks simply make more off that. Now, the banks will tell you, when they're asked to defend these rates, that there's a high rate of fraud in credit cards, that there's a high rate of potential default. But we know by looking at the credit rating agency's assessment of what are called credit card trusts, which is where the bank sells its receivables to investors, that 1/3 of all credit card borrowers are, quote, super prime. And what the bank is doing here is trying to say, look, this is a very low risk investment for you. And so if that's the case, why are interest rates on credit cards so high? And the answer, again, is lack of competition. So not only that, but there's a fee against the credit card, offering all kinds of benefits to cardholders, various lines of insurance and the like. I'm not entirely sure just how valuable that is to individuals, but fees matter, right? So in the book, I give an illustration. Every bank will, if you start a small business, will give you a credit card for $1,000, right? Credit limit. They'll charge you $150 for that. So that's a 15% interest rate, if you like, against the potential to borrow. If you actually do the borrowing, then there's another 20% on top of that. So if you were to run your $1,000 balance for an entire year, the effective interest rate, or the effective cost, is 35%. That's astonishingly high. So for banks, this is extremely, extremely good business. And at the end of the day, many people use credit cards more of a payment device than a borrowing device. And then merchants are charged 2 to 3% every time you tap that card. And so in a world that's becoming increasingly or uses cash, physical dollar bills, less and less, the banks make more and more money off of individual payments. And so we've all been into various small businesses that plead, would you please, could you please pay in cash?
We have about a minute left with this question. Can you tell us more about the story in your book where you got that intimidating letter from the bank, or was it a text message?
Well, yeah, I just thought it was illustrative. I, I remember looking at I think I missed a payment, just purely bad personal management. And as a consequence of that, TD Bank, which was the credit card, basically told me, you've been a really naughty boy. If you do this again, we're going to charge you even more than the egregious rate of interest that we charge. And I was looking at it and I thought, well, it's rather amusing, but it's also rather intimidating, right? I mean, if you were an individual that is sort of more marginal in terms of you're on very low income, or you lost your job, or you didn't have a lot of free cash flow, messages like that can be quite rattling, right? And so I thought it was objectionable. So I thought I'd share it with my readership.
Let's move on to our fourth question.
Sure.
You highlight how Canadians who plan to invest their savings are being ill-served if they go through their contacts at the bank. How do the wealth management departments gouge their own customers?
Well, it's not so. Is it gouging? I don't know. I wouldn't necessarily call it gouging, but I would say that let the buyer beware, right? And so if you go through what are called the supplemental financial statements or disclosure in the bank's quarterly reports, you see that the wealth management parts of the bank are extraordinarily profitable, and they make up an enormous share of all the non-interest earning revenue. So if you buy a mutual fund, let's say from a bank, the bank's own funds, a couple of years ago, 5 years ago, maybe a bit longer than that, that might have been a 2% charge every year. And the promise is that the portfolio manager is bringing you not only a diversified, say, selection of equities, i.e. meaning that you get better returns for a lower risk. And also part of the value proposition is that we are going to outperform an index. So you can buy the market index these days for any major market index, whether that be the TSX, the S&P, the NASDAQ, the FTSE, the Euro Stocks 50. You can buy that for a mere 6 basis points, right? And most of the analysis shows that the portfolio manager over time really doesn't outperform that index. So what are you paying for, right? You're paying somebody to manage an index for you. So banks will, when you go in to see them, let's say you've had a liquidity event, you've sold a business and you've got some money to invest, are very likely to show you their own mutual funds. And if you're smart, you'll say, no thanks, I want an ETF, or they'll show you their own ETFs. And so they have this ability, and many of the independent mutual fund managers that might perform better over time, you still have to look very carefully and do your research, have argued with the Ontario Securities Commission that the banks should have an obligation to show all of the investment vehicles on offer. And getting the lowest fee is really important, right? So, over a 40-year period, the banks could take more than half of the earnings over your lifetime, right? Because in the old days, they would charge as much as 3% for some of their mutual funds, which means at the end of every year, you're in a 3-foot hole that you have to climb out of over the next year just to break even to where you were at the end of the year. So the problem with fees is that it takes you out of the market all the time. And so your ability to earn the risk premium, if you like, is reduced. And so this has been a problem that thankfully the ETF market, the rise of the ETF market, starting with Vanguard, a US manager many years ago, has brought a degree of competition to that space. And so that's been very positive for consumers.
We have about a minute more with this question. Can you talk a little bit more about the lack of transparency with the wealth management departments at banks?
Well, again, you have to be careful, right? There used to be in mutual funds trailers, right? So the mutual fund company would give what's called a trailing fee to the investment advisor that sold the mutual fund. So the mutual fund with the highest trailing fee would typically be pushed by investment advisors, right? So once you're in that mutual fund and you stay in it, part of that fee that you're paying goes to your own advisor as almost like an annuity each year. And so unless unless that is disclosed up front, many investors do not understand how that fee gets distributed, right? So let's say half of the fee on a mutual fund, the bank's asset management arm keeps. The other half goes to their own advisors, let's say at the same bank, and then half of that will go back to the bank. So it's a very, very profitable business for when you ask the question, what's the value added to that? It's not really performance. Now, a lot of us need financial advice. Let's be clear. I don't want to denigrate the efforts of the advisors. I think they are genuinely driven to do the best for their clients. It's just the structure of the market and the lack of competition that delivers an outcome that's not necessarily always in the interests of the investor.
Let's conclude with our fifth question. Changes need to be made to the banking oligopoly if Canada is to flourish in the 21st century. What are your recommendations for policymakers to truly bring the necessary competition to this critical sector?
So the answer to that is to embrace the fintech world. Okay, so there's this concept called open banking, where banks are told, in a sense, by the regulator, share the customer's information with a variety of different providers of the services that the banks provide, right? Whether that's a payment service, whether that's foreign exchange, whether that's access to mutual funds, ETFs, or investment advice. Now, there are a number of technical things that you need to make that happen. You need instantaneous payment system, which we in Canada have been trying to do since 2022, that hopefully will arrive next year. Now, in those jurisdictions where open banking has been up and running for some time, the net result has been an improvement in competition, both in terms of the price of financial services has declined, the speed of payments has accelerated dramatically, and individuals using their cell phone, if you like, in the United Kingdom, which has been one of the leaders in open banking, gives you access to over 150 different providers of financial services. Now, not everybody uses this, but that doesn't matter. What matters is that there is a large enough number of people that use it to get the banks to sharpen their pricing, to improve their service. And this has been up and running in the United Kingdom since 2018. They announced to the banks in the UK they were going to do it in 2016. They had a well-financed implementation entity. They had an implementation trustee who had responsibility to make sure that the banks and the fintechs could agree on how this was going to go, so that you didn't get bogged down in each side having, unreconcilable positions. So it got done. It started in 2018. The first year, maybe there was 1 million people using it. Now you're up to 14, 15 million people. And so it has been the one innovation that has introduced competition to the banking industry, which in the past had been very resistant to any attempts to introduce competition. Why Canada is taking so long to do it, I think we need to ask both our banks, our payment system, and the federal government why this has not been executed more quickly than it has been.
We have about 90 more seconds with this question. Can you talk a little bit more about the importance of capping prices and rates that are excessive?
This is a difficult question to answer, right? Because we've always really, in the last 45 years or so, have moved away from active regulation. So I'm old enough to remember that when you when you got on an airline or were going to take a flight, there was a fixed price that regulators determined. And so airlines would attempt to compete on the quality of the service, the meals, being served a pre-cooked meal and then warmed up on bone china with silver knives and forks. Right? It's kind of ridiculous, right? So we deregulated in the late 70s, early 80s, across a broad swath of industries. We favored competition because we thought that will deliver better pricing, better quantity. And for a while it did. And so we backed away from active regulation, price caps, price determination. We backed away from consumer protection. But as you got into the late 80s, through the 90s, and into the 2000s, we allowed, in Canada, it's always been a problem, but in other parts of the world, there was, we allowed a lot of concentration and consolidation in industry to the point where there is now effective competition across a broad variety of industries. Prices are high and quantities are low. If we're not prepared to regulate, and governments are, very reluctant to get involved, then they should deliver a degree of competition. So that really is the answer. If you believe in competition, and what you notice is those countries that believe in markets and competition do better over time. And so it's high time that Canada took this seriously.
Andrew, that has been our 5 questions. You've answered them in 5 minutes. Let's move on to our bonus questions. Andrew, tell us more about your career trajectory. Why did you want to study economics?
I've always been interested in public policy. I've always been interested in the political chaos that surrounds economic change and the structure of economies. And so that motivated me to go and study economics.
Obviously, the book is a major accomplishment, but tell us more about another achievement that you're proud of.
So I spent about half my career working at banks, both international and Canadian banks, as an economist. And much to my surprise, I was invited to the Bank of Canada to be what's called special advisor for a year. That was in the early 2000s. And the Bank of Canada had struggled a little bit with how to communicate with capital markets, how to more smoothly implement monetary policy changes. And so they invited me into the bank to be an advisor to sort of help them navigate communication and monetary policy implementation. I'd say the best part of that was being involved in the Monetary Policy Review Committee. All right, so the Bank of Canada has 8 or so fixed action dates, and there's a whole process 3 weeks ahead of that, building up to all the analysis and all the discussion on what the appropriate decision is going to be. And I found that an absolutely fascinating process, and I was very pleased and honored in many ways to be able to be a part of that.
And our final question for you, what are you excited to be working on next? Do you have any other future book plans?
Well, everybody asks me that question. Are you going to do telcos next? I chose the banks really as a vehicle to animate the sheer, bad public policy with respect to competition. And I chose the banks because I knew them well, and I knew, where to go poking around. And so this book was less about the banks, although you wouldn't think that, right, from the title of the book. It was as much, if not more, a critique of Canadian public policy. So I don't have at this point any plans for another book. I am thinking about what I might write about, but I haven't quite nailed it down yet. There are so many interesting things going on in the global economy and in Canada. The fragmentation of global trade, the fragmentation of 80 plus years of security arrangements between the United States and others. The world is becoming a very, very dangerous place at the time, and there are many opportunities. But public policy needs to be, very focused on the big transformational change that's coming from artificial intelligence. At this point, is it hype? Don't know. We'll see. But what we do know is that general purpose technologies revolutionize economies, and we need to manage this, especially since AI does have the potential to do what humans do and to do it better.
Again, the title of the book is Fleeced. I highly recommend checking it out. If you're not able to buy it from your local bookstore, go to your library and read it because it is such a necessary topic that Canadians need to know more about. Andrew, where can people find you online? Let us know about your website, and are you active on social media?
Yes, I'm on LinkedIn. I write a Substack every 2 weeks to a month, depending on what's going on. And so if you want to get a sense of what I'm interested in, thinking about, and raising the awareness of, it's basically LinkedIn and Substack.
I'll put a link to the show notes to the book and to your information on Substack and on LinkedIn. Andrew, thank you so much for joining us on Books in Five.
Pavan, it's been a pleasure. Thank you very much for having me on.
The host of Books in Five is Bhavan Sodhan. Books in Five is produced in collaboration with Podfather Creative in Vancouver, Canada.